Hey everyone. So I wanted to talk about ranges a little bit after the week we had and how do you play them. This isn't going to be so much of an entries video as educational video as to what you can do, what you can look at, and what not to do, of course. So, speaking from a logical perspective, it's very easy to see that you had a high, you had a low. Now, aside from this, we stayed in this zone for quite a while, and a lot of people are probably wondering, what is the safe thing to do in a range when 4 hours is bullish, 15 minutes unconfirmed bearish? The first answer is look at the higher time frames. So daily, weekly, all that stuff, it's bearish. Even though 4 hours bullish, there is a higher probability of this going down and the bearishness continuing because daily's bearish. And the 15's not confirmed. That is some aggressive movement down too. So you could say the 15's not confirmed, but the 4 hours bullish. But then with the daily and the weekly being bearish, the sells are a higher probability. Now, depending what session you trade, when you get to the chart and all that good stuff, we can't look at just sells. So what do we look at? And from the simplest way I can put it is in a range we play the edges. So everything up here is a great zone to short from. Everything down here is a great zone to buy from. Everything in here is where you will likely become liquidity. And for those of you that have watched the course and watched the ranges video, you'll remember how I said play the edges, stay out of the middle. And that is exactly what happens in a zone like this. If we're buying, we want to be buying from down low. If we're selling, we want to be selling from up high. And if we are going to take continuations, there has to be a pretty good why, such as the weak lows that we just talked about in the continuation videos. Weak, 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 weak. Strong, strong. So, with that in mind, higher probability to short the bottom out of these for sure. The other way of looking at a range is if we're looking at the extremes, every time an extreme goes up, so if we came up here, then we made a low running this. We came back up, we failed to take this high, we ran this low. Failed to run this high, likely inducement for the next move. And then you have your supply here, also a weak low, equal lows, money down there. So the highest probabilities again to short. What does that look like for the buy scenario? The exact same. Nothing really changes. From a management perspective, though, you're going to be a little more aggressive on your management. So if we took a trade from here, chances are you're not going to try to run this high. Chances are if your trade's gone, 5, 6, 7, 8 R, you'll take partials because we don't know how high this is going to go up. And if you notice the way the market moves up, comes down, creates inducement, goes up, grabs the inducement. So this inducement's been wiped, creates inducement here, wipes the inducement, left inducement in the process. Comes down and grabs that. You guessed it, more inducement. Come on up, create another level of inducement. Come on down, run this low, and leave further liquidity here and here. What is likely going to happen? The market's most likely going to grab this inducement. And if you're always just looking at where did the move originate and could this move be a fake out and used as future inducement, you'll always find that if you're too low on the leg, you'll likely become inducement and you're trying to sell. If you're too high in a leg and you're trying to buy, you'll likely become inducement. So prime example, if you bought up here, there's a good probability that you just became liquidity for somebody and you were induced into the wrong side of the market to become that liquidity. So just looking at it from a logical perspective, you have supplies that are holding. Let's actually even go like this. We'll pull this wick. So you have a supply that is holding supply. Your next relevant supply is this one. And your relevant demand zone, you have these sell to buy wicks, which don't actually get taken. They get liquidated, but they don't get taken. This impulse down did not candle body close underneath it. The next thing you have is a bit of it's kind of a flip. I don't love it. It is a bit of a chalk and a flip though. And that's just from counting that. It's not a proper 15 chalk. It may be something on it's actually not even a 10 chalk. It's probably a 5 minute or something. But you're looking at it as disrespect to supply. Our favorite's obviously 15 chalks. If I can't get a 15, then I'll go on a different time frame. So speaking of that, actually, when we were up here, a lot of people weren't sure why people were shorting from up here. I had some DMs about it, and people were saying that the 15 chalk was down here. It never happened, and to an extent you're correct, that is the 15 chalk. But what do you have here? You have these sell to buy wicks. Now if we just cycle through our time frames, what do we have there? 14 minute, not the greatest thing I've seen, and 13 minute you have a chalk. You have a complete chalk here. This supply zone is responsible. Is that ideal? No, but 13 is close enough to 15. I would try to short off of that all day long. On the flip side of things here, the next London, this one does chalk properly. Take the lows, you take the highs. Again, something in these wicks caused that, and you'll likely look to take an entry. I would take partials at that high, and I would be probably, most of my risk would be completely off, and my trade would be completely closed out at that supply. So the idea in a range is just to play from high to low. Now this particular range here, our supplies at the extremes were respected. One of the things you'll notice in the range is this isn't typical. This doesn't always play out like that. A lot of times what a range will do is create some sort of crap like this, then it'll wipe the highs, then it'll wipe the lows, then it'll create a bunch of more crap like this, then it'll wipe the highs, then it'll wipe the lows, constantly running these highs and lows and grabbing all those orders and using them as liquidity to actually build their own orders. So if a buy program is initiated and they want 100,000 lots of whatever Euro USD to take up, it's going to take days to accumulate that without disturbing the market too much and staying within the ADR. So while they do that, the highs and the lows will generally get run multiple times, and then the actual move will happen. And then it'll likely mitigate and likely continue. Obviously, we don't know. The move could be this and then mitigate. We never know. So that's pretty typical for a range to get wiped a few times. So here we haven't really wiped the highs too much. Like, yeah, you wipe this. Yeah, you grab this inducement. You grab this inducement. But nothing's really touched these highs. And generally a range gets wiped multiple times. We did take a run at that low. We didn't quite get there. We were very close. We did tap into the last bit of inducement here. What that means now is this demand's got no inducement, so the next time price returns here, the probability of this holding is quite low, and if price starts heading that way, I will likely be looking to short that bottom out. On the flip side of things, if price does continue on up and these wicks get respected, this would be target 1. I would likely take partials at this supply. If we get past that supply and the market continues on up, then all of this becomes target, as it is liquidity for the taking. As for shooting to run this high, not likely, as the daily is bearish. So that's just how I view it. But again, everything goes back to playing the edges. Yeah, we're selling from here, we're buying from here, and you're always looking at liquidating. So one of the things you notice is the market will liquidate sell side, liquidate sell side. What is the market likely to do? Well, if the sell side liquidity is gone, where is the market likely going to go next? And the reason I'm talking about this stuff is, in a range, we're constantly locating sell side and buy side liquidity. So let's just chat about this a little more. So you have sell side down here, which we run. Now what you do is you create a bunch of buy side, which gets run, a bunch of sell side, which gets run, and now you have a bunch of buy side liquidity here. This is in this little region and NFP and all that good stuff. Let's look at what the market did prior to that. It's the exact same. So the market creates buy side liquidity, we run it. What's the market going to do next? We seek out sell side. There's no sell side liquidity left. What's the market going to do next? Buy side. Sell side, buy side, sell side, buy side, sell side. And this is called a range expansion. They accumulated however many orders of the a buy or a sell program they need, and they wiped everybody which way to do it. Anytime we're in a range, don't be aiming for these highs and lows. If anything, I'd be aiming for this low, not so much that high. But with that being said, pay yourself every time you run one of these lows. Pay yourself every time you run one of these highs. Every time you grab that liquidity, it's not actually guaranteed that you're going to go any further. And that is how we play a range. Typically speaking, it can be really said that we just basically bounce from supply to demand. And as long as you're grabbing liquidity, just be happy with that trade. If you got your 5R, you got your 8R, 10R, 12R, whatever it may be, this is not the place to be looking for 30R trades. Can it be the bottom or top of a leg? For sure. If you are going to hold it though, partial out and make sure you're taking something off the table, because especially with a pair like Euro USD, this can go on for days. For those of you that trade GJ can do this for 8-9 days straight. It's a little different though. GJ is more likely to do something like this, where it just keeps expanding, and then it goes little, and then it expands, and then it goes little, and ultimately it looks like just a terrible heartbeat. But that is what a range does. It'll just seek out sell side and buy side liquidity over and over and over. And if you grabbed one, you know the market's going to seek out the other, and it should now become a target. And if you just wait, you definitely have to get a little more creative and a little more precise. So on this area here, we have to go to a 13-minute to find the chalk. On here, you got a 15 chalk that was clean. Here, you got a 15 chalk in London session. This London session, I don't believe was that. Oh, it did too. Look at that. So it did come back to the origin, and then it during New York. If I remember right, I think you had to get in on a flip zone in here. And that's the middle of the range, which is, again, low probability. A lot of times you become liquidity, but again, you had a flip zone in there. as this is your last sort of supply. This is the demand that broke it. You can see the wick came back and tested that. And if we just actually, let's do this. Again, this is middle of the range, not my favorite place to take a trade. I didn't take that trade. I'm more about buying down here and selling up here. As far as being in the middle, I'm not too excited about. So again, same thing. You had a area that caused the flip zone. You could have put an order on half of this, which is pretty small. That's option A. You have inducement here. So that's a great area to get induced. Or you could have been smart and been like, the lows are run, the highs are run, and something in here caused it, and then take it on up. And with where we were, I would have likely just looked to run that high. So you would have had to. Let's just actually take this trade and mark it out. So you gave it a bit of room to breathe. Depending how much room you gave this to breathe. Oh, this is rather small. So you could probably give this 2 pips to breathe. The question is there even a 5R to this high, which I doubt there is. 4.7. I mean, if you took it with like a 1.7 lot, there's a 5R there. You might have been in that. In all honesty, again, you're in the middle. You have a high chance of becoming liquidity. I'm not a fan of that trade, but hey, if your risk tolerance allows that, by all means, try it. Myself, what I found in ranges is if you just stick to the edges and stay out of the middle, you're going to lose a lot less trades. And if you just wait, the chalk will happen. And the 1 minute chalk will follow. And if you don't get in on that. So here's a prime example. We had a chalk and flip. You had entry 1 there. And this is looking at this whole ugliness. That was a 13-minute area. So again, we'll just go sync and layout. So that was the origin that caused this supply failure. Again, you have a bunch of inducement. If that failed, you could have went on the extreme, or you could have did the smart thing, and this is probably what a lot of people would do, is you would have looked at this whole area as some sort of a demand zone. And you have a reaction point here, and along with your reaction point, you have another entry off this little doji. So that's probably the safest move. Again, if you can't get in on the original chalk, just look for the next flip. These areas do happen over and over. On the flip side of things, if we were looking at this London chalk, I am willing to bet there is an entry there. Let's actually just sync. So again, you really have, so you tap into the zone and you once again have sweep the lows, sweep the highs. There was no interaction between buyers and sellers. As you can see, we just came through it in one clean swoop. Anytime we have a big ass wick that is bigger than the body itself, we put an order on it. And again, that is your London trade. Now, if you got in here, a little bit of a big stop. Oh, that's actually not bad, 2.4. And as long as you can run this 15-minute high and have at least a decent risk to reward there, as long as minimum 5R, it's always worth taking. For those of you that are a little more cautious and maybe have a hard time holding, it might not be a bad idea to, take 30% partials here and let the rest run here. And then you can close 80% of your remaining position out here and then let the rest run to the next supply. That would be just how I manage this. Again, this is totally up to you. What did the previous London session do? And I just want to talk about the session timings too. Do you notice how the highs and the lows are generally it's around not far off from the London Open, and it's not far off from the New York Open. So here is your Asia midline. So you have, let's see, so you have, this is your Asia high, Asia low, Asia midline would be in here. This is typical liquidity down, so the sell side's gone, buy side's gone, and then it comes back down. I think there's one of the communities has a name for it. It's like the Asia whipsaw or whatever. And what it is usually whatever Asia does, London will come take the liquidity, induce people on their own side of the market, and go the other way. On the flip side of things, if London did something like this, and it took the bottom, it'll likely go that way. And sometimes it screws both sides of the markets. A lot of times too, New York will undo what London does. So London took it down after grabbing all the liquidity. And then the next thing you look at, so I'm going to be completely honest with you here, I likely wouldn't have caught that. And the only way I would be in this is 2 flip zones. So let's actually talk about this. If there is a chalk and a flip or 2 flips, it's usually enough to get involved if you don't have a clean chalk. But do you notice how all of these timings happen at the edges? And if we just wait, you can play these edges. So London, London, New York, New York. And you really didn't have to play in the middle unless you're trading Tokyo. And Tokyo a lot of times is the liquidity draw for these things. So you have a original chalk is swept the lows, and then as soon as this high goes here, a little bit risky. I'm not sure if I would have been willing to get in off just one chalk. And the chalk is there. It's a wick break. The high wick does break it. And once the high wick breaks it, I would look at this black candle previous to the high wick as the origin of the move. And that's what my order would go on. I don't know if I would get involved on that. I would want to see one more. I would want to see one more supply fail. Because usually after 2 fail, then you have yourself a move. You would likely cover all these wicks, so that's pretty tiny. You would likely get tapped in that. If you didn't get tapped in that, you again have to get involved right there once this high goes. And ultimately, if you wait for 2 supplies and 2 demands to break, it can be an entry. They work, I'd say, maybe 40-50% of the time. But if you don't have a chalk and a flip and a 15-minute to confirm you, then you need a couple of confirmations on the lower time frame. But as you can see here, the break actually originated from this wick, which you obviously do not get tapped on. Then you take the high again off the next doji, and you could see the problem with trading like this. So this, you'd likely not get tapped with spread unless you front run by spread, which I think you could have here because that seems like it. That's only 1.1 pips, so you would have definitely front run that. So you would have likely got tapped in on the bottom one. The next order never tapped, and then the next order finally got you in. I'm not a big fan of trading like that. I really am not. I don't know if I would have been involved in that. That might have been a session I sat out. If this hadn't tapped me in, I would have likely sat this out. You know, put this order in, put this order in. I doubt I would have kept chasing this all the way up the leg. I'm okay with sitting a session out, but our orders getting not tapped is fine. What I was trying to get across in what was supposed to be a 5-minute video, just to play the edges, and if we just wait, usually the highs and the lows are always printed by London or New York. Tokyo lows and highs are more of a liquidity draw, same with Tokyo midline, but generally, the other thing to keep in mind of, if say London puts in this high, which it did, you can see how the London high gets respected. It can safely be assumed, well, I shouldn't say safely, but you can start making an assumption that if London puts in a high and New York fails to take it, trade away from it. Now, whereas New York took this London high, then that would be possible momentum to keep going up. Seeing how you're close to this still and you don't think daily's going to become bullish, again, I don't know if I would have been involved in something like that. I'm very skeptical of ranges. So this is my sell zone. This is my buy zone. If I'm selling any lower in the leg, it's probably because I'm looking at running a low. If I'm buying any higher up, I likely wouldn't take it past this supply because the chances of us running that in one go are not very high considering it hasn't been mitigated. The only thing I will say is this range has been wiped and there's really no inducement sitting here. So if we did come up here, I don't know how strong this zone would be anymore. And this whole zone would be a 4-hour supply, but we've tapped that multiple times. So yeah, there's a possibility of running that. Again, lower possibility than running down though, going with the higher time frame. But yeah, I'm going to end this video here because I feel like I overtalked again. Yeah, just trade the edges in a range, guys. If you can't be running structure, then start running substructure in between. Sometimes you have to, not sometimes, a lot of the times you'll have to trade areas like this. We're in the range a lot. But yeah, have a good day, everyone, and I will see you guys in the next video.